Did you know that what's in here, emotions like excitement, fear, or anxiety, can be some of your greatest obstacles when it comes to investing? That's why today we're talking about exit strategies and how using one can help you make more informed and rational decisions. An exit strategy is a mechanism you set up that's designed to help you sell an investment. That is, a stock, ETF, mutual fund, etc., when certain conditions are met, like hitting a high price or profit percentage, or a low price or profit loss. Even changes in a company's performance trends. They can be a number of things. When these conditions are met, your investment is sold no matter what. It's pretty much automatic.
And when investing is automatic, emotion is taken out of the equation. Emotion can really impact the way you make decisions. But when you have a strategy and stick to it, there may be benefits, like minimizing risk and potentially maximizing profits. Let's imagine there are two investors, Nadia, who has an exit strategy, and Sam, who doesn't. Nadia researches the company Soul Symphony and decides to invest $100 worth. She's comfortable selling at a high of $120 and a low of $90. Sam, on the other hand, is a huge sneakerhead, so he throws in $100 on a whim without any plan for when to sell. When Soul Symphony launches their new shoe, the Skyscraper 2000, their stock jumps to $120. Both Nadia and Sam are feeling great. Sam's excited about the gains, and Nadia's happy because her exit strategy has already kicked in. Her shares were automatically sold at $120. But when the rival shoe company drops the Max Squish 8000, and Soul Symphony's stock plunges to $80, Nadia is unaffected because she's already locked in her profit. Sam, on the other hand, panics and sells all of his shares at a loss. What's the lesson here? Nadia and Sam invested in the same stock at the same time, but Nadia outperformed Sam by having an exit strategy from the beginning.
Now that you know what an exit strategy is and why it's important, let's talk about how to actually build one, starting with this question.
How will you measure the performance of your investment? If it's dollars per share, like the example we just talked about, you may sell when it reaches a high or a low dollar per share amount. If you're measuring its performance based on, say, the company's latest financial statements, you may sell if that company has a bad year. Two great ways I like to research these measurements are with fundamental and technical analyses, both of which can help you determine the best time to sell or adjust your strategy. Fundamental analysis focuses on getting to know the company and understanding what factors may affect its stock price, like the company's revenue, its financial health, and what's happening in that particular industry. Technical analysis, on the other hand, focuses on price trends, using charts to track how a stock's price has moved over time and indicators to help identify patterns or potential market conditions. Building a great exit strategy also involves figuring out how long you want to hold your investment based on your goals. Setting a time horizon can help if that stock begins to move sideways and isn't hitting your high or low targets. It can also help you stick to your plan if you have a specific timeline. Another important part of building an exit strategy is figuring out when to actually exit. One way is through profit loss targets, something that is entirely up to you and your comfort level. It's less about analyzing company data and more about defining your risk tolerance. You set two numbers. The first is how much you want to profit, and the second is how much you're willing to lose. For example, in a 3-to-1 target profit loss ratio, you'd aim to make $3 for every dollar you're prepared to risk. Let's go back to Nadia's investment with Soul Symphony of $100. What if her goal was a 3-to-1 target profit loss ratio? It would mean that Nadia was aiming to make 3 times the amount she's willing to risk. Here's how she'd do the math. First, Nadia decides she's comfortable losing $10 per share, so she subtracts that from the original stock price of $100. Now, if Soul Symphony stock drops to $90, Nadia automatically sells because she's hit her loss threshold. Then, to figure out her target profit, she'd multiply her $10 risk amount by 3, getting $30. She'd then add this to the original stock price. Now, if Soul Symphony's stock rises to $130, Nadia automatically sells to reach her target profit. Most brokerage companies, including Fidelity, have trading tools that can calculate your ideal target profit loss ratio right there within your portfolio. So now that you know when and why to exit, let's talk about how to exit. There are 3 main ways. First, there's a market order, which lets you execute your trade immediately at the next available price. It's sort of like a trade it now button. My pro tip, set an alert so you know when your desired price hits. Another useful order type is a limit order. This lets you set a specific price, then it automatically executes your trade if that price hits, without having to constantly check back. The only downside is if that price never hits, the trade won't go through, and you may continue to hold that investment even if the price plummets. That's where a stop loss comes in, because unlike a limit order that makes you buy or sell at a specific price, a stop loss helps protect you from loss by automatically selling your investment if the price hits at or below your set price. And there are other order types you can use to exit a trade, like stop limit orders and conditional orders. To learn about how these work, I have an article I'll link below.
All right. If you have any questions on what we just talked about, drop them in the comments below, and our Fidelity team will reach out. Till next time, investors.